Hey everyone, thanks for having me. My name is Erik Lundh. I'm a senior economist at the Conference Board. The Conference Board is a 109-year-old nonprofit, nonpartisan think tank for businesses. And I'm going to talk to you today a little bit about our long-term outlook for the global economy, how emerging markets and BRICS nations are playing a role in that outlook. And then also, we're going to touch on the short-term outlook for the global and the U.S. economy, and how some of the tariffs that have been proposed in Washington may impact that outlook. So first and foremost, I want to talk a little bit about, as I mentioned, our long-term outlook for the global economy. So the Conference Board produces a variety of forecasts, both sort of short-term 1 to 2 year forecasts that we do on a monthly basis. And then annually, we update our long-term 15-year forecasts for the global economy. And so what we do essentially is we look at 77 economies around the world, and we look at trends that are occurring within those economies, and we extend them outwards to get a sense of what the future might look like. We do this using a growth accounting framework from the supply side. So we're looking at things like capital contributions to growth, labor contributions, and something called total factor productivity. This differs a little bit from the accounting that most people are accustomed to, which is the expenditure approach, which is consumption, investment, government spending, and net exports. So we use a variety of variables and lags to make these projections. I should also note that we are forecasting what's called potential GDP growth, which is a little bit different from actual GDP growth. Potential growth is essentially the sustainable average growth rates that are likely to occur in the future, given that you efficiently use all of the inputs that you have at your availability. So from our most recent exercise, which was published in November of last year, it's not very different from the one prior to that. We continue to expect a gradual slowdown in the global economy over the course of the next 10 to 15 years. So our projection over this decade is average growth rates of about 2.5% versus about 3.4%, which is what we saw in the decade prior to the COVID-19 period. Now, a lot of the slowdown that we are projecting to see is associated with that labor component of GDP growth. And that is tied to, of course, structural themes that we're seeing in terms of demographics. There are demographic crunches occurring in a variety of economies around the world. Europe is having an especially difficult one. China also already starting to see implications in its labor market, and to a lesser extent, the US as well. And so as a function of that, the amount of growth associated with the labor contribution is expected to moderate. Capital should stay relatively stable at about 2% or so, ebbing a little bit more in the late 2030s. But the positive sort of side of this is that we are expecting to see a reacceleration in productivity growth over the next 10 to 15 years. And this follows a period following the global financial crisis in 2011 to 2019, where there was actually very little in the way of productivity growth. So some advents like artificial intelligence and other technologies, as they continue to diffuse themselves globally and across businesses, we're expecting to see an increase in that green bar productivity that should help to slightly, or partially I should say, offset the slowdown that we're likely to see associated with labor. So in terms of the composition of the growth, it's not going to be evenly distributed between emerging economies and mature economies, and indeed it hasn't been for decades. We're forecasting that we're going to continue to see both mature and emerging economies see slower growth rates in the future, but emerging markets will continue to disproportionately drive growth. Now, a large part of this is associated with China and with India. We are actually forecasting that China and India do themselves see their growth rates moderate over the coming 15 years, but still there'll be a significant enough growth rates that it's really going to be one of the primary growth drivers in the future. In terms of the breakdown in the global economy, mature economies will continue to cede a share to emerging markets over the forecast horizon. We expect mature economies' share of global GDP to fall from about 45% today to about 38% in the late 2030s. The U.S.'s share will likely fall about 2 percentage points to 14% over that period. Europe's share likely to fall about 3 percentage points to 15%. And meanwhile, BRICS economies should see an increase of about 5 percentage points to 39% of overall global GDP. So BRICS economies will become increasingly important to the overall global economy over this period of time. So what does this mean in terms of BRICS? Well, BRICS is an informal pact of emerging economies that formed to serve as a counterweight to the G7. It's expanded in recent years. Over the last year, several new countries have joined the BRICS organization, and it's expected to get larger and larger over time. One of the major focuses of BRICS has been to develop alternatives to Western-led international order. However, to date, it's made little progress to affect meaningful change within international institutions. BRICS is also seeking to increase trade between its member states, especially in local currencies rather than the US dollar. China's RMB has grown in popularity as a currency in recent years, but it still accounts for only about 2.5% of international trade versus about 66% for the US dollar and a very large share in the euro as well. So looking ahead, as BRICS expands and becomes a larger share of the global economy, its influence in these two spaces in terms of institutions and currencies is likely to grow as well. So these are all sort of long-term structural themes, but I want to pivot a little bit and talk about more short-term outlook. So in the short term, we forecast that we'll see a little bit more volatility in terms of growth rates around the world. In Europe, we're expecting growth to gradually improve over the course of 2025 and 2026. This follows a period of weakness in 2024, most notably in Germany. Some of the shocks associated with the COVID-19 pandemic, the war in Ukraine, are moderating in some ways in Europe. Inflation is generally cooling, and monetary policies among central banks like the ECB are continuing to loosen. In Asia, India will continue to grow over the coming years, but perhaps less rapidly than it did in 2024. During that period, India's economy was growing well above its potential growth rate, and we expect it to moderate over the course of this and next year. For China, the picture is a little bit more complicated. There are numerous structural headwinds to Chinese growth that continue to unfold. There are, as I've already mentioned, acute demographic challenges that are currently having real impacts on the Chinese economy. There are severe imbalances in terms of the residential property sector in the country, and there's also weak consumer sentiment as well. So all these forces should inhibit the kinds of strong growth that China used to be accustomed to. In terms of the US, we expect economic activity to continue over the course of 2025 and 26, but perhaps at a more moderate rate than the ones that we've been seeing over the last 1 to 2 years. Post-pandemic growth rates have been well above potential US growth, and we expect them to converge over the course of the next 1 to 2 years. Consumers will continue to buttress economic growth, especially in the short term. Inflation is also likely to continue to gradually cool towards the Fed's 2% inflation target, but we don't expect that victory to actually be achieved until most likely 2026. In the meantime, we expect the Fed to keep rates on hold for the first half of this year. We expect the next rate cut probably to occur sometime this summer in June perhaps, and potentially see 3 25 basis point rate cuts in the second half of 2025. We'll continue to see some cuts, we think, in 2026 as well as inflation stabilizes toward that 2% target. But in the end, the terminal rate that we're expecting from the Fed is likely to be around 3%, elevated relative to the kind of neutral rate that we saw prior to the COVID-19 pandemic. That said, there are a variety of risks to the outlook. Recently, we've been concerned especially about the implementation of large tariffs and how this might disrupt the economy. So as I mentioned, tariffs are a large concern, and the recent set of tariffs on Canada, Mexico, and China, we've actually been doing some work on to get a sense of what the potential implications could be macroeconomically. So as I'm sure most of you are very well familiar with, the proposed tariffs include a 25% tariff on Canada and Mexico and a 10% tariff on China. A 30-day extension has been granted on those Mexico and Canada tariffs, but the 10% tariff on China has already been implemented. It's very difficult to say, of course, whether all these tariffs will be implemented and for how long. That having been said, we can use what has been said and apply it to the data that we have to get a sense of what the potential implications might be. So in terms of inflation, the set of goods that would be hit include a wide set of food items, consumer goods, energy, and automotive goods as well. Many of these categories have already seen significant waves of price increases in recent years. So to get a sense of what this might mean to overall inflation, we use what's called a general equilibrium model to introduce a set of shocks that correspond to these sets of tariffs. And these are the results that came out of that modeling work. In the event of a 25% tariff on Canada that is implemented for a full year, the resulting increase in US inflation is likely to be about 0.2 percentage points. The 25% tariff on Mexico also results in an increase of 0.2 percentage point. China, 10% tariff, about 0.1%. And a combined effect, if all three were layered on for a full calendar year, would likely result in an additional 0.6 percentage points in inflation in the US. So we're also able to model the potential implications on GDP growth as well. So these scenarios all represent a deviation from our base case forecast for the economies. So for instance, for the US, we're forecasting a growth of about 2.3% for this year. For Canada, we're forecasting about 1.5%, and for Mexico, we're forecasting about 1.3%. However, in the event that these tariffs, again, are implemented, these represent the delta from those base cases that we could potentially see. So in the first scenario, with the 25% tariff on Canadian imports, we could see a headwind of about 0.4 percentage points to US GDP and about 0.7 percentage point on Canada. For the 25% tariff on Mexican imports, we're looking at a headwind of about 0.4 percentage points on the US. Mexico, about 0.7 percentage point. 0.9. For China, 10%, we're looking at about a 0.2% drag on the US and about a 0.1 percentage point drag for China. And then when you aggregate all of these together, it has a nonlinear impact, in which case all three of these tariffs implemented simultaneously for a full year would likely result in the last set of numbers that we're looking at, 0.9% for the US, 0.9 for Canada, 1.2 percentage point drag for Mexico, and then 0.2 for China and 0.3 in terms of global GDP growth. So those are the potential scenarios that we've modeled in terms of this set of tariffs, but we've also been modeling other ones as well. The new administration had already previously mentioned a few other potential avenues they might take. So again, assuming that we were to get something like a 60% tariff on all Chinese imports, the resulting impact on the US GDP would probably be about a 1 percentage point headwind to overall growth. And also in terms of a 10% universal tariff on all imports coming into the US, regardless of country of origin, that drag looks to be something along the lines of 0.7 of a percentage point in total. So what can businesses do about this? Well, we can kind of reflect back a little bit on some of the policies that we saw introduced under President Trump's first term in office. Things that we recommend some of our businesses do include stocking up now. So similar to the 2018-19 trade war, firms should be prepared to stockpile and accelerate shipments to try to avoid the tariffs. Seeking alternatives, companies should consider substitutes for critical inputs where appropriate and if feasible. Seeking exemptions. So during the last administration, President Trump's last term in office, a lot of exemptions were made to some of the tariffs that were put up. Companies could apply for those and have their imports exempted. That may turn out to be the same during this current wave of tariffs, so it is certainly one strategy as well. And then in general, we're encouraging companies to really sort of think a little bit more critically about reorientation of their supply chains, some diversification, and segmentation as well. So that's sort of the modeling work that we've done in terms of the tariffs. That's our longer-term outlook for the global economy. And I'm happy to take any questions that people have. Do these forecasts, let's see here. Do these forecasts? No, so the question is, did the forecast, and I should have made this clear, do they also take into account retaliatory tariffs that I've issued? No, they do not. These are the scenarios that I walked through, the shocks that we implemented on our models, all just assumed one set of tariffs. They do not incorporate retaliatory tariffs on the part of other countries, Mexico, Canada, China, et cetera. So there is, I would argue, even further downside risk to some of the growth and inflation, well, especially the growth implications for the US in terms of just the hit to exports coming out of the US into other countries are going to be put at a disadvantage as well. Another one. So the immigration policy question is a really important one as well. U.S. labor market remains fairly healthy. It is tight. It's not as tight as it was 1 to 2 years ago. So there have been some reentry into the labor market that we've seen for people who maybe dropped out over the course of the COVID-19 pandemic. But of course, large-scale removal of people in the U.S. Shrinks that labor force and could sort of reverse some of the progress that we've seen in terms of the availability of labor. So that's a potential downside risk as well that we could see unfold. I haven't done personally a lot of work on that, but it is something that my colleagues are currently looking more deeply into. See, okay, so how do these forecasts change if Ukraine, Russia war stops and supply chains improve? I think the forecast, especially in Europe, it improves in that kind of an environment where there's a cessation of hostility. In Ukraine, it could be beneficial in terms of energy prices as well, helping to maybe moderate some inflation. But I would definitely say it would be an upside sort of risk to our base case forecast at this point. Could you expand on the future role of AI and its impacts? So it's hard to model. There's been a lot of work that's been done to try to say what exactly the implications of artificial intelligence will be macroeconomically. But I think that presumes that you actually know what direction AI is going to go in, which we don't. So in terms of the kind of forecasting that we've done over that long-term period, that chart that I showed earlier on, we do make certain assumptions about just increased levels of productivity rates resulting from some of those technologies, but I don't have a terrible amount of confidence in the point estimates that we've put together. I think there are potentially upside potential in terms of the GDP the TFP forecasts that we put out for the next 10 to 15 years. Let's see, why is India getting a hail pass from this administration on tariff actions? I don't think anybody is sort of getting a pass at this point. I know that there is some work that's presently being done to assess the competitiveness and the barriers for U.S. exports globally. And that report, I believe, is scheduled to be finished on April the 1st. Once that report is completed by the U.S. government, we could potentially see an additional wave of tariffs come out of that as well. To date, the tariffs that have been threatened on China, on Canada, and on Mexico are in response to some of the concerns that the administration has about immigration flows and about the flow of fentanyl. And there are legal routes through which the White House is able to use tariffs to try to address those issues. But those strategies don't necessarily apply to more conventional usages of tariffs in terms of reciprocal tariffs on, for instance, if China has a tariff on this, and you can erect a tariff on that in response to it. Those kinds of tariffs are going to be enabled after this April 1st report is finished. And so what I expect to see is a wave of additional tariffs in the coming months. So India doesn't necessarily get a pass, I don't think. We're going to have to wait and see sort of what happens over the next few months. Let's see here. What impact will the significant shrinking of the U.S. federal government workforce have on your estimates for U.S. growth? That's a great question. I don't have an answer for you necessarily. Our forecasts, especially for the short term, over the next 1 to 2 years, we do use that expenditure approach, which includes government spending. So the extent to which a cut in the government workforce could impact the amount of government spending that occurs, that would, of course, impact GDP. But it's hard to say sort of how a reduction in headcount is going to map exactly to a reduction in government spending. I don't know what the exact sort of implications would be in terms of a downshift in, again, government expenditures. So it is 10:02. I think I've gone over by a couple of minutes. Should I hand the microphone over to the next speaker at this point? Sure? Okay. Thanks, everybody, for having me. It's a very volatile environment. We do our best. So I hope the talk was helpful.